I'm calling them the fateful eight. The fate of the market is in the hands of these 8 stocks, Dan. So let's talk about Microsoft's underperformance, and let's also talk about coming into this year, your top picks. None of them are in that Mag 7, and I'm assuming maybe not Broadcom either. So let's just call it the fateful eight.
Yeah, I mean, I think, you combine with the fact that companies like Marvell or Broadcom are helping the hyperscalers develop their own chips, and that's another headwind you have. But really, the big headwind is if you have the biggest companies in the world slowing down their CapEx because they're just not seeing the returns. Because think about it this way, Microsoft, after they reported their June quarter, they guided below the street for revenues for the September quarter. Then when they reported the September quarter, they guided below the street for the December quarter. So, and it's been mixed for all of the other hyperscalers as well, with the exception of Meta, which is not really a hyperscaler, but Meta has been getting a lot of great returns from their spending on AI. But for the rest of them, it's sort of been a mixed bag. And so much like you saw during the internet infrastructure build out, you went through these periods of strong growth, then pauses, then strong growth, then pauses. And I think you're going to go through a period of pause, because if you step back and you say, okay, the world is led by consumer demand, right? GDP in the US is 70+% coming out of a consumer. What consumer device has AI really spurred demand of? Hasn't been smartphones, hasn't been PCs. There's really nothing. So you built out all this infrastructure, but the resulting revenues that you're hoping to drive just aren't there. There hasn't been a killer app. And that's really the issue when you're spending this amount of money. And Microsoft stock was only up 12% last year. P was up 23 and dramatically underperformed the rest of the Magnificent Seven because their cash flow was getting just crushed as their CapEx as a percentage of revenues has gone from 12%, let's say, before AI to over 25% with the spending they've been doing on AI. And that's the biggest ramp you've seen out of any of the big three, with Google and Amazon more like going from 10% of CapEx as a percent of revenues to more like mid-teens over that same period of time. So, and I think all of them are looking at each other, trying to figure out how much are they going to spend, because when one guy blinks, I think you're going to see the rest of them blink as well. So the CapEx guidance for all of these companies, with the exception of Meta, which is seeing the returns to justify their spending because their numbers have gone up a lot last year, which is why the stock did so well. I think that's one of the big things I'm going to watch.
This kind of brings me to Meta for a second. This was one of your top picks coming into 2024. You talked about that outperformance.
And 2023, actually.
Yeah. Since the lows in November of 22, the stock's up, nearly 600%. But I want to go back to one thing. And so from the moment that company renamed to Meta, this was in late November 21, the stock sold off nearly 80% to its lows in 22. That's almost unfathomable if you think about it right now and the way the stock or this company is positioned. And a lot of the spending that went into Meta was repositioned, right, into the kind of, generative AI focus, this Llama, this open source model. They're getting the benefit, like you just said, the way they're placing ads. And there's going to be a whole host of things across all of these different platforms that is under Meta. They have, billions of monthly active users, whether it's on Instagram or the Blue Page or WhatsApp, and I'm probably missing one or so. But I think to myself, why have investors just kind of disregarded the fact that this is a company that lost 3/4 of its value, right, at a digestion phase? They went into this period of rationalization. They started cutting a lot of employees. I think it was 10,000 in 22, 10,000 in 23. And today they just announced a 5% cut. Now they keep saying that this is kind of low performers. That doesn't matter. That's what happens during RIFs. You know what I mean? And I just wonder about the timing of that. Are they going back into a period of rationalizing costs? And so I just, again, if the uptake of these products slows down, right, they're not finding the return on some of those investments maybe as they get into 25. I wonder if if this stock is vulnerable because you have, 11% expected earnings and sales growth. It's not trading that expensive at 23 and a half times this coming year, but it is relative to growth. And we start seeing, gross margins are expected to come down maybe 1% from, 83 and a half or 8 to 81 and a half. So I'm just trying to get my arms around this Meta, because the outperformance off of the highs where many of the Fateful Eight are not acting as well. So I'm curious how you're thinking about Meta right here, right now.
Meta right here, right now has nothing to do with any of that. It all comes down to TikTok, right? If TikTok gets banned, the stock will work at least for a short period of time. If it doesn't get banned, then the stock's going to have downward pressure. From a fundamental basis, when you think about when they report the quarter and guide, the thing you need to think about, and this applies to Google as well as all the companies that rely on internet advertising. The first thing is you've got no presidential election. You had the most expensive election in the history of the planet, Q4. So all of those ad dollars go away in Q1. You also don't have the Olympics in 2025, which you also had in 2024. And then finally, most of these companies only guide out 1 quarter in advance. And Easter is an important period for these companies as well in terms of holidays. Easter last year was on March 31st. This year on April 20th. So you're going to have that spending also shift out of Q1. And then if you want to get really granular, you don't have leap year either this year, where you had it last year, which added an extra day. So you put all of that together, and Meta has, and then the fact that they're the only one of the big mega cap names that really saw a massive return on their AI spend, because their estimates went up a lot last year because they were spending a lot, but the numbers kept on getting revised higher on both revenues and EPS because they were using all this AI spend to figure out, okay, what videos will Dan Nathan watch? And then what ads will he engage with? And so they use that AI really, really well to drive their business, where the other companies are spending a lot, but it didn't necessarily show up in revisions to revenues or EPS. So with Meta, those are the things, and for Google as well, right? The calendar shifts, of Easter, no leap year, no election, no Olympics, all of that obviously affects Google as well. And Amazon's advertising business, obviously. And so those are things you kind of need to think about as you get into this. And Meta always guides conservatively when they start a new year, and it gives them the ability to beat. And they guide conservatively only on CapEx and expenses. They never give you any idea what they think the revenues are going to do. And so typically this is the quarter where you have to worry the most. And so, we'll see. I looked at the RIF. I didn't think too much about it because I said, well, maybe that confirms my fears that with no election spend, business falls off. But there's a reason why Meta isn't a top 5 pick for me this year when it was in 2023, right after the stock had gotten murdered in 2022, as well as in coming into this year. And that's why I don't have it.
Yeah. Again, Meta's interesting because you saw, like you said, this huge step up in earnings year over year from 23 to 24, 50% or so. Sales were up 20%. And again, you see a step down in that growth to 11, 12% or so. And like I said earlier, there is a margin degradation, 81 and a half down to 80 and a half. So maybe if they guide conservatively, it's something that you want to take somewhat seriously, especially if they start cutting CapEx. There's two ways you could think about that. But again, I think we've kind of beaten this dead horse a little bit. I wanted to ask you about Apple, because this is one you just mentioned. What are the use cases, right? And this is a company that has not spent tens of billions of dollars to kind of create that generative AI infrastructure to train models. We know very clearly what they did with OpenAI. Apple Intelligence is a bust, and they shouldn't have come out so aggressive on it. It was just disingenuous, if you will. You're not seeing this upgrade super cycle. I know this is stuff that you track pretty closely. And then the last part about it is, like, when is this going to be in China? What will be the reason why Chinese upgrade their 300 million iPhones that are probably 3 years old within there? And so I say to myself, Apple's losing market share, which they are globally. It's not growing versus, the global handset market that I think grew like 4% this year. They're down 2%. Why did this stock break out the way it did in November and December. It grinded higher. It was obviously only multiple expansion. It's given a bunch of that back now. Thoughts on Apple? Because right now I say to myself, if you own an iPhone and it's getting old, and based on some of the reporting we've seen about the hardware changes that's going to happen, and then hopefully they get this Apple Intelligence a bit better, you will not upgrade your iPhone unless it breaks, in 2025 until the fall. Is that fair?
Yeah, I think all that's fair. And this kind of goes back to my discussion on 2022. People don't care about inflation until they care. And it's the same thing with Apple. Apple's a retail darling. There's massive retail ownership. 70% or something of the US population has an iPhone in their pocket. And when the stock is doing as well as it is, portfolio managers have to own it because they're judged, especially if you're a long-only manager, you're judged on relative performance, and Apple about 7% of the S&P 500. And I think what happened as you rolled into this year is people put off selling their big winners until you got to this year because you're thinking, well, maybe Trump, I get lower taxes under him. And so why would I want to take the tax hit in 2024 when I can put it off into 2025? Because none of the data has been good. I mean, if you look at it from a 3-year perspective, Apple's revenues on a cumulative basis over 3 years is up 5%. That's what some of these other mega cap names do in a quarter. Like, it's absolutely pitiful. But the multiple has gone from a teens multiple to 31 times, which is where you've gotten the performance. Now, to be fair, if you look at it the last 3 years during this, slow growth, it has underperformed the information technology index. That's up about 51%. Apple's up 41. It's just relative to the S&P, it's outperformed. But relative to the other mega cap names, it's underperformed. And so I think with Apple at a certain point, like I always love listening to the bulls on Apple, every year it's an upgrade cycle. And every year it gets pushed back. And then the multiple expands because the Fed either is pausing in 2023 or cutting in 2024. It's a massive portion of people's benchmarks in the mutual fund community. And so guys are sort of stuck with this, and retail loves the name because everybody owns an iPhone, right? And so one of those weird things, much like when did people care about inflation? I think if they have another bad guide, which I think they will, because of losing market share in China, and this has nothing to do with the Chinese market, everything to do with them losing share in the Chinese market, which is a totally different problem. I think people are going to care, and the way the stock's acting to start this year tells me that maybe people's mindsets have actually flipped on this as well in terms of how they're thinking about, why am I paying 30-something times with the S&P at 25 times for a company that's barely growing? And by the way, estimates are for 7% revenue growth this year. Unless there's some killer app that comes out, I don't know how they're going to hit that, because in Europe, you don't even have the AI capabilities. China, God only knows if you'll ever get them, and the government will allow it. And so you're really left with the US, where demand still isn't all that great. And so for me, Apple, we'll see, but I think people are starting to care, much like they started to care about inflation kind of in mid-December.
Yeah, and the one thing I'll say that the bulls point to, and it makes sense to me to some degree, you think about that market share here in the U.S., you think about the hope for that killer app, like you're saying, on top of hardware that has been very iterative. The mix shift from hardware to services has been a bright spot. In 2019, this is a company that had 38% gross margins. Next year, expected to have 47%. So you could see if they nailed Apple Intelligence, how the mix shift could get better and you could revalue, but it's already been revalued,
yeah,
I guess.
But here's the other side of that. What happens if, okay, they nail Apple Intelligence, that's great, but Google can't pay them to over $20 billion a year in pure profit to be a default search.
Right. Yep.
Your margins are going to get absolutely destroyed. So that's the other side of this, which if the multiple's a market multiple of 25 times, that's fine. But when you're sitting at a market multiple, by the way, their market multiple right now is the same as NVIDIA's, which grew revenues at 100% last year, over 100% the year before that, and is expected to grow 50% this year. That's the risk reward you're taking on. And who knows, maybe the multiple continues to go up. anything is possible. I lived through 2000. We all saw what happened with GameStop. If you want to go back further, Volkswagen and that short squeeze back in '08. I mean, all kinds of crazy things can happen, but a certain point, fundamentals matter. Maybe you've gotten there.
No doubt. Here's a name that you mentioned before, and I think it's one that folks don't talk a lot about relative to the other mega cap stocks, is Amazon. So, I go back to this past summer, the stock had that huge gap on disappointing retail sales. You had AWS, which, they're losing a bit of share. Growth has slowed fairly dramatically here. You mentioned the advertising business, which is actually one of the big bright spots here, right? And I think one of the reasons why the stock has worked this back half of 24, obviously it's come in a little bit, is that, this promise of a reacceleration of North American retail, that AWS bottomed. This company hasn't done the spending. They've been investing in a company like Anthropic, but they haven't done the sort of spending that, let's say, Google Cloud or Microsoft Azure has done. Does that all make sense to you? Because I think about, expected growth here, and I think about the multiple, and it seems about as reasonable as I can remember. Does that make some sense on a PE to growth?
Yeah, but let's be clear, they're the second biggest spender behind Microsoft. So they're spending a ton on AI. The thing is with them, when I recommended that stock for last year, a year ago, I said that's not because of AWS. It's because of margins in their retail business and things like advertising and Prime Video. That's really what's driven this company. Because as much as we all spent talking about AWS, if you can get the margins on your razor thin retail business, though, that's where you get the massive leverage in EPS. And that's what you've seen. And so with Amazon, I think this year you can still get some of that help on the retail side. But again, as I said earlier, right? Shift of Easter from Q1 to Q2, no election spend, no Olympic spend, which helped them on, the Prime Video advertising. All of that is going to play in. And don't forget the satellite keeper project that they have, which is to compete against Elon Musk Starlink. That thing absorbs a ton of capital, and it's massive. It's going to be a hit to your margin structure. And so that's something that people kind of talked about, was a problem when they reported June quarter, kind of went away in September. But Amazon has pretty much told you they're going to try to compete against Starlink, and that's going to cost a lot of money in that ramp up phase. And that's why we're not recommending Amazon coming this year, though, of the Magnificent Seven, it's probably the one, if I had to pick one to go with, that's probably the one I would pick because of the retail side of their business actually potentially having some more margin levers in it.
Yeah. And I guess you could also make the case on the flip side of all of that. You just mentioned the potential margin hit from the satellite business, right? If you had a consumer weakening, unemployment going higher, that retail business could flatten out a little bit. And then you have a scenario where the pricing power that a lot of these companies had with COVID savings and the like, they don't have that 3 years on, right? If you think about this digestion phase, which you just laid out, right? AWS could cut that growth, or that rebound could flatten a little bit. So, and then advertising, which has been great for margins, but pretty cyclical. So you could make a pretty easy case where a lot of these things start going south at the same time too. I just brought it up because it's not a name that I hear people talking about as much as NVIDIA and Microsoft and Google and Meta, if that's fair to say.
Yeah, and that's probably fair to say. The one thing we haven't talked about, which affects all of these names quite a bit, is the US dollar. Because don't forget, the dollar at the end of Q3 was at 101. The dollar right now is at about 109. So that is a 7 to 8% hit to all your international revenues when these companies guide for the March quarter. And most of these names have a much higher exposure to international markets than the S&P, which is somewhere in that 30 to 40% range. You've got Apple closer to 60%. And so that's one thing that's a headwind for all of these names that you're going to have to deal with. And so we'll see how that works its way through. Because in an environment like this one, where you've seen NVIDIA reverse very hard off of, the highs it got to on CES, and you've seen Apple go down. When stocks aren't going up, regardless of what's happening, then people start to look at things like estimate cuts, and they're not willing to be as magnanimous about forgiving it. And so if the dollar also causes issues on top of everything else we've talked about, that's a headwind regardless of who you are.